Mr. U.R. Bhatt, Managing Director of Dalton Advisors, joins us. Hi, Mr. Bhatt. Good morning. Fantastic to have you back. What's going on, sir?
Well, I think more of the same, more pain as we have seen from the beginning of this year virtually, largely on the rupee front and to some extent on the market front. Because as you see, in dollar terms, the market is probably down by about 12-13%. And so therefore, I think unless the rupee sort of stabilizes, I don't think there is much hope for the market. Largely because of the fact that fixed income investors, FII investors in India are sort of on the way out. Today, as of now, I think probably less than about a quarter of their investments in India have been taken out. So there's quite a lot more that could happen if the rupee continues the way it is going.
Number, since you said that a lot of money is moving out, I'll give you the number. $8 billion of equity in outflow, or in the month of June, we've seen equity outflows of about $8 billion. That's nearly 60% of what we've got in this calendar year. But despite so much of outflows, markets are still holding on.
I'm not very sure whether $8 billion of equity money went. I think $8 billion of total FII money went, including fixed income securities, bulk of it being fixed income securities. I think the equity one is under $2 billion. So be that as it may, I think the risk of trade internationally is something that would continue, largely because of the fact that the U.S. economy seems to be on a mend. And so therefore, the talk of QE3 being tapered off is very real, and I think consensus is that something like about a quarter of the $85 billion per month would probably get tapered off sometime in November. So this is, really very close. Plus also you have the fact that in Europe things don't look very good. You have a political situation in Portugal not very encouraging. You have got today a meeting on Greece, whether their aid should continue, whether they can meet their commitments to the international community. Plus also you have confusion in Egypt. I think all these things together would make Europe like somewhat vulnerable. Even though of course it is not to say that the euro is really under big threat of its existence, or that there is a huge bank default on the horizon. Nothing like that is really there. But still, Europe continues to be on the boil. And in China, you have seen there is some amount of trepidation there. The economic numbers coming out of that country have not been exactly encouraging. So I think on the whole, there is a risk of trade internationally, and that would certainly, because India has been a big beneficiary of the monetary easing internationally. And when that tap sort of gets turned off, at least partly, I think India has to pay for it. And so that is what we are seeing, whether in the fixed income market or in the equity market. And unless, of course, there is a dramatic change on the economic firmament in India, thanks to dramatic changes in the policy environment, I think we'll probably have more of the same.
Mr. Bhatt, every story has two takes. For every buyer, there is a seller. The fall in rupee surely will not benefit Indian economy, but it will benefit exporters. IT companies and pharma companies are likely to make money hand over fist. So do you think there is a no-brainer trade in large cap IT and large cap pharma stocks?
Well, large cap pharma maybe, large cap IT because there has been a salary increase the last quarter. So therefore, that impact might not really show up dramatically in the performance for the June quarter. But I think going forward, this is certainly going to be something that could influence prices of the IT stocks. IT stocks are certainly well positioned, at least some of them, not all the large ones. But I think some of them would certainly gain quite a lot. Those who have some amount of pricing power would gain disproportionately largely.
Mr. Bhatt, is it time to buy Infy ahead of the earnings on Friday?
Well, that is never a good idea because it's very volatile during the results. So therefore, it's quite likely one could get caught on the wrong foot. So I think it's best for most investors to stay off.
So what's the expectation then? Should one gear up for a guidance cut from Infy this time?
That's what I think most analysts seem to be saying, that there might be some sort of a guidance paring down. So therefore, I think one should brace oneself for that.
If I look at classic or basics of investing, some of the best trades are always made when there is outright despair. There is a big shakeout in the bond market. There is outright despair in the rupee market. Is it time to go in now?
Well, I think nobody can call the bottom very accurately. So therefore, if one has a 2 or 3 year horizon, I think one should start nibbling in the market. And as investors, I think one can't really get prices get stocks at the lowest prices. So one should probably, I think even public sector banks for a change might be at these levels. If you have to invest 100 rupees, maybe worth investing 10 or 15 rupees in these stocks. Plus also it's worth probably continuing to be slightly defensive, investing in the private sector banks, investing in FMCG and pharma, as you said. Plus also I think there's a case for people, for investors to consider even investment in the infrastructure stocks, because finally, I don't think government has much of a choice now. They have to do something on saving infrastructure from utter ruination, virtually, before the elections. So they will have to do a lot of spending. They will have to ease policy. And so therefore, I think it's, and at least the ones who are not terribly leveraged, I think there is some hope there. So I think this is how one should mix and match the portfolios.
You just talked about how the tilt of the market is going to remain towards the defensive. So do you think the names like Rupee, Dr. Reddy's, even in a weak environment like this, would continue to make fresh highs day after day?
That is what recent history has told us, and I think that is what would continue, because if people have to hide under these circumstances, it is all these stocks only. Sorry. These are the stocks that can give some value or some safety, and I think that would be the sort of the mood of the market for quite some time.
Mr. Bhatt, looks like you're going to catch on your throat. Do you want to sip some water, then I'll come back to you?
Yeah, fine, thanks.
Okay, markets, what do we have there? 240 points down for the Bank Nifty, so the Bank Nifty surely is under intense pressure. Mr. Bhatt, are you ready? Can I come to you? Okay. Mr. Bhatt, I would like to draw your attention to private banks, and you've been hot on private banks. At a time when Indian economy is unlikely to recover, the growth, the marginal change may not be all that constructive. Is it time to even exit private banks, because nothing is immune if the economy doesn't recover?
Well, I think that is certainly the right macro call. But I think, if you have seen recent history, it is at least the new private sector banks which have really given a very good account of themselves despite the slowdown in the economy and despite massive accretion of NPAs by the public sector banks. So therefore, there is a case for continuing investment in at least the new private sector banks, because they have given a very good account of themselves in managing the environment over the last couple of years. And so I think there is certainly a huge skill gap between the new private sector banks and the rest of the banks. And so that needs to be rewarded, and that is why these banks are quoting at a premium. And I think even at these levels, there might be a case to be there.
Have the large cap and quality private banks, have they corrected enough, and do they warrant a buy now? Or you think they could correct by another 10-15% and one should wait it out to get better entry points?
There could be a further correction because, if there is no progress on the infrastructure sector, I think the amount of NPA accretion that could happen on account of, lack of action there could be quite significant. So therefore, this sort of sector can have a huge impact on the public sector banks especially. But, I think you should take a bet, you should be at least somewhat optimistic that the government will do something to address the concerns of the infrastructure sector. And so therefore, as I said, since you cannot really catch the bottom, so I think you should start nibbling even in the public sector banks. As I said, 15 rupees out of 100 rupees that you've allocated to this sector probably could be invested there now.
But Mr. Bhatt, on the downside, does it seem like the Nifty is going to remain intact around 5,500, max 5,400, or do you think there could be further downside to the market? 5,500
seems to be a very good bottom as of now. But all bets are off if Rupee continues to slide down further, rather plunge down further, and there is a huge divestment of the FII holding in even in fixed income securities. So therefore, I think that is something that we need to watch carefully. If, say, for example, Rupee goes another say about 10% down, I think all bets are off. But pending that, I think 5,500 seems to be somewhat safe.
Fair point, Mr. Bhatt. Good chatting with you. It always is. Thanks for taking time out and joining us.